Welcome to episode 2 of Nova Bourse US. Today, we are pulling back the curtain on the invisible machinery that powers the world's most sophisticated financial system. We are going to demystify exactly what happens behind the scenes from the moment you decide to invest until your trade is finalized. Every single time you buy a share of a company like Apple or Tesla, your order embarks on a journey through a complex pipeline involving brokers, electronic exchanges, and private networks. Many beginners assume this is instantaneous, but understanding this infrastructure is vital. It protects you from hidden costs, prevents slow executions, and helps you avoid unnecessary losses. In this session, we are tracing the full life cycle of your trade to show you the real mechanics that ultimately determine the price you pay. The scale of this system is truly staggering. As of mid-2026, the United States equity market is the largest in the world, with a total market capitalization of approximately $75.3 trillion. Between the New York Stock Exchange and the NASDAQ, over 5,400 companies are listed. On a typical day, more than 10 billion shares change hands. When the opening bell rings at 9:30 a.m. Eastern Time, the system is flooded with roughly 10 million orders in the first 60 seconds alone, representing about $50 billion in trades. This is not a human-driven auction. It is a high-speed electronic network operating in milliseconds. To understand the market, you must distinguish between the two giants, the New York Stock Exchange and the NASDAQ. The NYSE, dating back to 1792, operates as an auction market using designated market makers to facilitate trades for its 2,100 listed companies, including industrial pillars like Coca-Cola and J.P. Morgan Chase. Conversely, the NASDAQ, founded in 1971, was the world's first electronic exchange. It functions as a dealer market and hosts over 3,200 companies, serving as the primary home for tech titans like Microsoft, NVIDIA, and Apple. While they both trade all day, their underlying operational models differ significantly. Trading is organized into 3 distinct sessions. The regular session runs from 9:30 a.m. to 4 p.m. Eastern Time, Monday through Friday. Outside those hours, we have the pre-market session from 4 a.m. to 9:30 a.m. and the after-hours session from 4 p.m. to 8 p.m. These extended periods rely on electronic communication networks rather than traditional floors, and most brokerages only permit limit orders during these times due to lower liquidity. Today, some brokers like Robinhood, Schwab, and Interactive Brokers even offer 24-hour trading, 5 days a week, providing overnight access to major S&P 500 and NASDAQ 100 stocks. The opening bell is more than just a ceremony. It is a critical function. While the tradition dates back to the 1870s, it has evolved into a mechanism where the NYSE opening auction determines the official price for each stock. By matching all buy and sell orders submitted before 9:30 a.m., the exchange establishes a fair, orderly starting price. This is particularly vital on days of high volatility, where stocks might otherwise gap up or down from their previous close. It ensures that the market begins on a stable footing after absorbing overnight news. If the open is important, the closing auction is the absolute titan of liquidity. In the first quarter of 2026, over 605.5 million shares, worth $43 billion, traded daily at the close. On March 20th of that year, the market set a record with 3.57 billion shares matched, totaling $230.5 billion. Institutional managers and index funds rely on this definitive price for their benchmarks. Despite this massive volume, about 18 million shares go unfilled daily due to a lack of matching buyers or sellers, leaving over $500 million in untapped demand. At the core of this activity is the central limit order book. This is a real-time electronic ledger that organizes every buy and sell order by price. When you submit an order, it sits in this book waiting to be matched. The system tracks the bid, which is the highest price a buyer will pay, and the ask, which is the lowest price a seller will accept. These orders are anonymous, showing only price and quantity. The matching engine updates thousands of times per second, and studying this book is the best way to see the true supply and demand dynamics for any given stock. The bid-ask spread is essentially the cost of immediacy. The bid is what you get if you sell instantly, and the ask is what you pay if you buy instantly. The difference between these two is the spread. For giants like Microsoft, The spread might be just 1 cent during regular hours. But for smaller stocks, it can widen to 50 cents or more. During extended hours, spreads almost always widen due to fewer participants. Remember, when you buy at the ask and sell at the bid, you are effectively paying that spread twice, which is why liquidity is so important for your bottom line. When placing a trade, you have two primary choices: a market order or a limit order. A market order executes immediately at the best available price, which guarantees the trade happens but not the specific price you pay. In fast-moving markets, this can be risky. A limit order, however, specifies the exact maximum you will pay or minimum you will accept. This guarantees your price, but if the market never reaches your level, the trade will not happen. Most brokerages force you to use limit orders during extended hours, because the lack of liquidity makes market orders far too unpredictable for retail investors. When you tap buy on your phone, your order doesn't head straight to the exchange. It travels to your broker's servers in 10 to 50 milliseconds, where it is validated against your account balance. Then, your broker makes a routing decision. They must decide whether to send your trade to a national exchange, a market maker, an electronic communication network, or use their own inventory. While the Securities and Exchange Commission mandates that brokers seek best execution, brokers also have financial incentives to route orders to specific venues. Where your order lands directly impacts the speed and price of your trade. Your broker has 4 main venues to execute your order. They can route it to a national exchange like the NYSE, where it meets the order book. They can send it to a market maker like Virtu Financial or Citadel Securities, who fills it from their own supply. They can use an electronic communication network like NYSE Arca, which matches orders outside traditional exchanges. Finally, they can choose internalization, where the broker fills the trade using their own shares. SEC Rule 606 requires brokers to disclose where they route your orders and whether they are paid for that flow, ensuring some level of transparency in this fragmented system. Market makers are the middlemen who keep the gears turning. Firms like Susquehanna International Group, Jane Street, Jump Trading, and the 2 largest players, Citadel Securities and Virtu Financial, stand ready to buy or sell at quoted prices. They profit from the bid-ask spread and use ultra-low latency algorithms to manage risk across thousands of stocks simultaneously. They account for a massive portion of retail equity volume. Without these firms providing constant liquidity, the markets would be incredibly inefficient and spreads would widen significantly, making it much more expensive for you to enter or exit a position. The NYSE uses a unique model with designated market makers, or DMMs. Unlike the competitive dealer model of the NASDAQ, each stock on the NYSE is assigned to a specific DMM firm, such as GTS or Jane Street, which is hired to maintain an orderly market. DMMs have extra responsibilities. They must dynamically add liquidity to the order book when public interest is low and actively intervene during the opening and closing auctions to dampen volatility. In 2019, they provided 17% of liquidity-adding volume. They serve as a critical stabilizing force, especially during periods of intense market stress. You might wonder how zero-commission trading is possible. The answer is payment for order flow. Market makers pay your broker, such as Robinhood or E-Trade, a small fee, usually a fraction of a penny per share, to direct your order to them. For a 100-share trade, the broker might earn about $1. Critics argue this creates a conflict of interest, as brokers might prioritize the highest-paying venue over the one offering the best price. The SEC regulates these arrangements and requires strict disclosure. In 2024, the Commission approved new rules to modernize these disclosures, with updated requirements slated to take effect in December 2025. Internalization is another common practice where your broker acts as the counterparty to your trade. If you buy 50 shares of Microsoft, your broker might simply sell them to you from their own existing inventory rather than sending your order to an external exchange. The broker makes money on the spread. While this can result in very fast execution, your trade never hits the open market. Large firms like Fidelity and Schwab internalize a significant amount of flow. The SEC requires these firms to prove that their internalized prices are at least as good as what you would have received on the open market. In the world of professional trading, speed is measured in microseconds, 1/millionth of a second. While your retail trade executes in 10 to 50 milliseconds, institutional systems confirm trades in under 50 microseconds. The Securities Information Processor, which consolidates data from all exchanges, takes about 410 microseconds to report trades. This speed is necessary because, in the first minute of the trading day, 10 million orders hit the system. Prices can move significantly in the time it takes for your signal to travel from your phone to the market, which is why these tiny fractions of a second matter so much to high-frequency firms. To protect investors, we have the National Best Bid and Offer, or NBBO. This represents the highest bid and lowest ask available across all U.S. exchanges at any given moment. SEC regulation NMS requires your broker to match or beat this price. If the best bid for Coca-Cola is $62 on the NYSE and the best ask is $62.05 on the Nasdaq, the NBBO is $62 to $62.05. Your broker must execute within this range. However, because the consolidated feed can lag behind direct exchange feeds by microseconds, the true best price is sometimes slightly different than what the SIP reports. This leads to an important reality. The price on your screen is not always the real price. Because exchanges sell faster, proprietary data feeds to institutional traders, those players often see price changes microseconds before the consolidated feed updates your brokerage app. For the 30 stocks in the Dow Jones, the consolidated feed lags behind the true market price thousands of times every single day. This latency arbitrage is why institutions pay millions for co-location services, placing their servers inside exchange data centers. For a long-term retail investor, this gap is negligible, but it explains why the market is so intensely competitive regarding data speed. Trading during pre-market or after-hours sessions comes with increased risk. Because these sessions use electronic communication networks with fewer participants, liquidity is thin and spreads are much wider than during the regular day. If a stock has a 1-cent spread at noon, it might have a 10-cent spread after 4 p.m. This is why most brokers only allow limit orders during these times. A market order could trigger at a terrible price due to the lack of depth. Earnings reports are often released after the close, causing volume spikes, but you must be careful. Not all stocks trade in extended hours, and the risk of poor execution is significantly higher. The newest frontier is 24-hour trading 5 days a week. Platforms like Robinhood Interactive Brokers and Schwab's Thinkorswim now allow you to trade major indices and ETFs overnight. This evolution caters to a global market where investors in Asia and Europe want access during their own business hours. However, be aware that liquidity is at its absolute lowest during these overnight sessions, leading to even wider spreads and higher volatility. Only limit orders are accepted, and there is a short 5-minute maintenance window before the regular market opens. The NYSE Arca exchange has even moved toward a 22-hour per day schedule to compete in this global landscape. To wrap up, when you place a trade, you are interacting with a fragmented, highly regulated, and incredibly fast ecosystem. Your order is routed based on broker incentives, handled by market makers, and governed by rules like the NBBO to ensure fair pricing. You have learned about the roles of DMMs, the reality of payment for order flow, and why price latency exists. Understanding this machinery won't make you rich overnight, but it does turn you into a more informed investor. You now know how to evaluate your broker's execution quality and understand that every trade has a hidden cost, the spread, which you should always keep in mind. In our next episode, we move from the machinery of the market to the tools you use to participate in it. We will cover the differences between taxable brokerage accounts, 401k plans, and IRAs. We will break down why choosing the right account is often more important than choosing the right stock, explain how employer matching works, and discuss the tax implications of traditional versus Roth accounts. Remember, taxes come first in any investment strategy. Join us for episode 3 as we walk through the essential accounts you need to start building your portfolio.